Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Allison Williams joins us. She's our senior banks analyst. She's also the director of research for all the U.S. research stuff they do at Bloomberg Intelligence. So she's got a lot of hats to wear, so we appreciate getting a couple minutes of her time. Goldman Sachs, Bank of America, what are your takeaways today, Allison?
So it's been a good quarter. You wouldn't know it from the stocks, but net interest income, core net interest
income. I could make huge money running a bank today. With interest rates, they're paying like nothing to you and me, the depositor, and they're loaning out at these high rates.
What are the margins? What are the margins like right now?
They have actually started to pay up, and so we have seen that, right? So that's been a little bit of a headwind. That's what people are worrying about. But the cost of deposits, the rate of those costs increasing is slowing. So, Paul, you know we like a second derivative, and we like when the second.
But is there an overall number? Right, you know, like at Bank of America, the average deposit payment is like, I don't know, I would guess like 0.5%, right? And the average amount that they're charging on a loan is probably more like 6. I mean, what are we looking at?
I mean, it depends bank by bank. And so, and by the way, if you did your math, you'd get a much higher spread than you're actually earning on the margin. So it's really like a couple of percent, depending on the banks, depending on the mix, and we could get into the weeds and talk segment by segment. The wealth segment, for example, much closer to matching the market rate, right? So if you have a balance of a few $1 million, you're going to be a lot more sensitive in terms of moving that balance very quickly. Yeah. Commercial balances, similar thing, right? People that are managing those balances are doing it for a living, so they're obviously going to move those. So in those two segments, we've seen the cost very much matching what's happening on the funding side. It's really the consumer banks where you have very much smaller balances. Even then, you would think it's, people should be moving. And Paul, you talked about your savvy daughter looking at Marcus and the highest rates there. But some people are slower to move. And if you think about Wells Fargo, Bank of America, JP Morgan, huge retail branches, tons of these mom and pop deposits, especially Bank of America and JP Morgan, gaining that share over the last several years. And so that's really the benefit is those big, the deposit base and the portion of that deposit base that pays, closer to zero.
Not the hot money, right? That was the worry last quarter, is the hot money, which means
like John Tucker's money.
No.
Oh, okay.
I mean, and correct me if I'm wrong here, but that is basically brokered deposits, right, Allison? So the worry was that it's not just Marcus that's paying more than 5%. There are a number of other upstarts that are paying decent interest rates.
Correct.
And so you have brokered deposits that just move back and forth all over the place, and investors don't like to see too many of a bank they own, too many of those deposits brokered, right?
They don't. That's why they really look for the core deposits, and they're really looking for those super cheap deposits that live, as I said, in the consumer unit. So not the wealth or the commercial or the higher beta, as we would call it. Not beta as we know in the market, but a deposit with a high beta to the market rate.
So what are we hearing from the likes of Mr. Solomon and Goldman Sachs about just the investment banking businesses? Doesn't seem to be a lot going on over there anywhere.
So if you look at the fees, it doesn't seem to be a lot going on. But I think what investors are focusing on are some of the commentaries beneath the surface. So obviously you're familiar with the fact that there's activity. You start those conversations, and then you see the uplift in fees a few quarters later. And what was exciting in September was a lot of commentary from the Goldman Sachs and other banks that things were happening beneath the surface. We're hearing a bit more of that today from both Goldman and Bank of America. Equity fees has been disappointing. We did get a few deals, so we're looking for things to get a little bit better. Debt fees being helped out on the high yield side. And M&A, despite very low levels, at least increasing from the second quarter.
So one of the things that I've been amazed with over the last 10, 12 years is the whole growth of the private credit business. And that seems to be actual fees that are leaving Wall Street and going to the private credit business, whether it's from the leveraged loan business or the high yield market. What do the Brian Moynihan's and Mr. Solomon's, what do they say about that business? I mean, it seems like they just let that go. I mean, and let it walk across the street.
Yeah. So if you looked at if we looked at sort of large corporate lending, that tends to be almost like has been over the long term a loss leader for the banks. They want it more for the overall relationship, right? And then the types of lending that tend to be profitable, sort of that core bread and butter commercial business. I think that's where maybe some of the BDCs have tried to become more competitive. But the big, the business right now that's working and the business that's good for these banks over the long term is card. Because that's, the consumer business has much higher yields.
Yeah, but back in the day when I was at Chase, Allison, I'd do a big leverage loan to Comcast Cable, $1 billion loan. We'd get a big fee up front. We'd get a nice LIBOR spread. We sell off 90% of our loans. We'd have to, muddy up our balance sheet, and then we turn around and do it again. I thought that was a really good
you're talking
business.
about so leverage lending is obviously a little bit more exciting, and again, you're talking about the full relationship, right? Like you're really looking for the fees and the full relationship. And keep in mind that, even when banks do loan syndications and such, like they're generally selling off those pieces as well, right? Like they're looking for the overall origination fee on that business.
So what's the outlook for investors here? Are clients you talk to, are they buying the Goldmans of the world? Are they buying the Bank of Americas, the JP Morgans, or are they just waiting to see how the economy shakes out?
It's definitely the latter. Okay. People are still very focused. Investors are very focused on commercial real estate. We know that that's something that's going to take a long time to play out. I mean, the banks we're seeing weakening, and that's what we expected, but it's going to be a slow process. I think investors definitely get concerned when some of those concerns start playing out in the CMBS market, which moves a lot quicker and, has shown some significant decline. So we know commercial real estate is coming, but broadly, credit is very strong. And investors are also still looking at those unrealized loan losses. We did see a tick up. Bank of America spent a lot of time talking about their portfolio this morning. And I think that is just something that, again, it's going to be a while. So the stocks, as I said, are not responding to the good earnings. And then we have these two concerns that are just going to take a fair amount of time to play out. And at the same time, investors are trying to grapple with what do higher rates mean? What does that mean for the economy? Credit loss tends to be the big wild card, and what's going to happen next year if these rates continue to be high?
Any most dangerous times quotes today? I mean,
well,
Jamie Dimon always makes
Jamie
headlines.
Always kicks off earnings season, and he always does make some good headlines. I think the most interesting thing, if you read between the lines in some of his comments, he's continually said, at least for the last couple of years, that the world needs to prepare for higher rates, although the number he throws out there continues to ratchet up. And so a bank should prepare for any type of risk scenario. There are a lot of there's a lot of risks out there, but he has also been saying, last Investor Day he talked about sort of detailed all the unprecedented times, and we've continued to have some risks since then.
All right, good stuff. Allison Williams, as always, senior banks analyst for Bloomberg Intelligence. She's also the director of research for the Americas for Bloomberg Intelligence. So a busy plate.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Retail sales came in this morning much stronger than expected, so you can't keep a good consumer down, it doesn't appear. So I want to see what this really means for the global macro environment here. Russell Price joins us. He's the chief economist at Ameriprise Financial. He's based in Detroit, Michigan, but he is here in a Bloomberg Interactive Brokers studio. We appreciate that. Russell, thanks so much for joining us here. Again, the retail sales numbers come out pretty darn strong. This consumer, you can't hold this consumer down. How did you read these numbers, and how does that kind of weave into your economic outlook?
Yeah, certainly it's further upside that's likely for third quarter GDP. But retail sales, it shows that consumers still have a lot of money available to spend. Even if they don't, maybe they're adding it to the credit card. and they're certainly willing to spend. A big jump for this morning's retail sales came from restaurants and bars. 0.9 month over month shows consumers are still looking to enjoy themselves after the pandemic. Some of the areas that were down were even just down after big jumps the prior month. We had a 0.8 decline in electronics, but that comes after a month that we saw a 1.2% increase the month before. And so consumers are still driving this bus, and even if we have the student loan repayments beginning here in October, it's still they still seem to be spending at a good level.
Where are they getting the money, or is it credit? Because I recall at one point looking at a graph from Torsten Slok over at Apollo that showed credit card usage taking off. It scared me at the time, but everybody I ask about it says, well, we're just getting back to pre-pandemic levels.
Right.
How do you see that?
I'm not very worried about credit card debt because, yes, we are at an all-time high. But just because of the way the Federal Reserve measures credit card debt gives it a natural upside bias. It measures it on average monthly balance. And so the more and more we as consumers use our credit cards, the days of emergency use only, those days are long gone. It gives it a natural upside bias. So what I do, there's no real way to factor that part out. But what I do is I look at consumer credit card debt relative to overall consumer income. And on that basis, we are at very healthy levels. We're well below what we were pre-financial crisis, 2009-2010 timeframe. So even though it's at record levels on a dollar basis, it's still very manageable.
I mean, to me, it would be worrying to roll over any debt at what are rates on credit cards? People are just putting stuff on credit cards and then not paying them off every month with 25%, 30% rates? That doesn't sound like a smart decision.
Well, even if you pay it off at the end of every month, just because your average monthly balance is higher, it's still higher. So that's why it boosts it
now I'm
up.
coming along with you. Now, now I'm getting on the same page here. I see. So that doesn't sound like I mean, if you looked at what I charged every month, you would be probably shocked.
I'm sure you have a huge cash burn with your lavish
It's massive.
lifestyle.
And I mean, probably spend, like a good American, more than I earn, right? But but I do pay off the balances because I don't want to get hit with that interest rate cost.
Hey, Russell, are we gonna see a recession here, and if so, how deep? I mean, I personally, for my forecast, I've taken that off the table. Although no one cares about my forecast, they care about your forecast. What are you thinking about that?
Well, I think the most likely path still implies that we're likely to avoid a recession. But as we were talking earlier, I think the negative influence of higher rates are still to be seen as their full impact on the economy, particularly when it comes to small businesses, refinancings, office refinancings, and auto loans, things like that. So there's still more pressure to come. So we do expect the pace of economic growth to downshift over the next few quarters. And as such, it really wouldn't take much for that downshift to push us a little bit lower if we were to see something such as a spike in oil prices to boost gasoline prices, to push us into negative territory for a short period of time. So even if we do see a recession, I think it would be very shallow, and it would not, what's most important in most people's mind, it would not likely push the unemployment rate up beyond 5%.
What's your view of, federal spending to me seemed to be moving at cross purposes with what the Federal Reserve was trying to do, right? I mean, we're just pouring money on this economy out of Washington, D.C. as the Fed is raising rates to try and slow down the economy. The bond market seems to be a new player, though, involved in this. As they drive up rates on the long end, is that tightening financial conditions enough?
Well, it certainly is, clearly. But I do think that we'll start to see some alleviation in the upward pressure in market-based rates, Treasury rates in particular, because part of the boost that we've had over the last few months was from the Treasury Department rebuilding its checking account. Back in June, we had the Treasury balance down below $40 billion, and now it's built back up to over $640 billion. So the checking account is largely rebuilt. Usually they keep that at a level between 300 and 500 billion, so it's pretty flush today. So that component should alleviate. We still have obviously deficit spending, and the Federal Reserve working off its balance sheet. So there's still a lot of upward pressure. So once we see further confirmation that inflation truly is subsiding, and I think that's what the market's waiting for, is further confirmation of that data, that we should start to see rates moderate a little bit. Not
but
much,
we're
but
on, 5% watch out
Yep.
30 years, right? The 30-year right now, 4.949%, up 10 basis points today. The 20-year has already been in past 5%. So does that, you think, is that a high watermark for yields?
I think it'll end up being close to it. I think we'll probably be at these levels for a little while longer. But again, as we move into 2024, the inflation outlook starts to get a little bit better. The Federal Reserve indicates that they're more on pause. I do think that we'll see those rates come down a little bit, maybe somewhere between 1/4 and 50 basis points. So they'll come down somewhat. That'll alleviate some of the concern about the economic environment, and I think we'll have some upside for 2024 overall.
Hey, Russell, just real quick, you're based in Detroit. A lot of your fellow Detroit folks are on strike here. When are they going to work something out here between the auto companies and the auto
Yeah,
workers?
that is a very difficult question. Certainly, I don't have much insight into the negotiations by any means, but it is something that's a rolling pressure on activity in the area. Fortunately, we didn't see much of that in today's industrial production report.
That's right. Yep.
Manufacturing activity still expanded, but certainly the auto industry needs to see that resolved sooner rather than later.
And you guys have a football team this year.
That's a very good.
That's a
good
big
point of
one.
news.
What, the Lions?
Yeah.
That's right.
That's the NFL, Matt.
That's okay with me.
Okay.
As long as we're just talking about the Lions and the NFL.
Yes,
Yep.
That's all you need to know. Russell Price, thanks so much for joining us. Russell Price, the Chief Economist for Ameriprise Financial, joining us live in our Bloomberg Interactive Brokers studio.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Talk about a diplomatic full-court press. U.S. Secretary of State Antony Blinken in Israel for the second time in like a week. Now we've got news that tomorrow President Biden will be going to Israel as well. Let's get the latest on kind of what this means for this difficult situation. Henry Meyer joins us. He's a reporter for Bloomberg News based in Tel Aviv here. Henry, it seems like the United States, obviously the top political folks making their way to Israel to try to, I guess, improve a very difficult situation. What's the feeling in Israel about President Biden coming over tomorrow?
Well, clearly, it's seen, first of all, as a signal of U.S. support at this really critical time for Israel. They've been preparing now for a ground offensive into Gaza, and the U.S. has been pledging, military support and also saying that it supports Israel's right to defend itself in the face of a lot of criticism now of the bombing which is taking place in Gaza, and concern about the civilian casualties that will result if Israel does indeed decide to send ground troops into Gaza.
What is the status of that right now? I mean, I imagine they're still all amassed at the border. They've swept as many or pushed as many people from the north of Gaza down to the south in order to get in there. Is it imminent? I mean, are you hearing anything about the timing of the invasion?
What we understand is that, it is planned to take place imminently. I mean, clearly, it's not going to take place while these visits are occurring. I mean, today we have the German Chancellor who's visiting, tomorrow President Biden. But, it is anticipated that it could start pretty soon after that. At the same time, the U.S. has also been telling Israel, both privately and publicly, that it's got to do everything to avoid civilian casualties. So it's not clear whether that will influence the type of operation that Israel is going to conduct in Gaza.
Henry, I guess here in the States, we're watching like everyone else here. One of the questions that I think a lot of folks have is how much collateral damage to civilians and others do you believe that Israel is willing to inflict in an effort to achieve its stated military goals? Is there a sense of, in Israel how far they really want to go?
I mean, everyone that you speak to here says that, they're in a new reality now,
Okay.
and, they have to go to the end. They have to achieve the objective. The objective is to dismantle Hamas militarily and its administrative role as well in Gaza. Of course, this does risk extremely high civilian casualties. There are already 3,000 almost Palestinians who've died in the bombing. And although, yes, they have succeeded in getting large numbers of people to move south, still, there are several 100,000 left in the north, and there are airstrikes also taking place in the south as well. So, the risk of collateral damage is very real.
Why are there airstrikes in the south? I thought they moved everybody to the south to avoid the airstrikes in the north.
Correct. What we understand is that they said there were targets that they had to focus on, their Hamas targets. So it's not that they're bombing, as much in the south as in the north, but nonetheless, that is taking place according to what we've heard.
Henry, prior to this, the terrorist attack, there was a fair amount of division within Israel, profound division within Israel, due in large part to Netanyahu and what he was trying to do with the judicial system. To what extent, post-attack, has the average Israeli, do they feel more united? Give us a sense of just what it feels like on the ground in Israel, talking with Israelis on the street.
I mean, Israelis have put aside those differences for now. I mean, this is a national emergency, and the country has come together. And one of the illustrations of that was the protest movement that was raising funds to protest against the judicial reforms. Those funds have now been redirected to help the military effort. You have a government now which is an emergency government which includes the opposition. So yes, the country has come together.
And Henry, it seems give us the latest reporting from the West Bank. It seems quiet there. What's the latest reporting?
Well, I mean, it's quiet because the Israeli authorities, the same day that the terrorist attacks happened, launched a massive clampdown, security clampdown. So they've been, carrying out mass arrests. They have been limiting, the movement of people within the West Bank. So, they knew that was potentially going to be another flashpoint, that there could be a spillover into the West Bank, and so they have taken very, very tough measures to prevent that from happening.
What is the value, Henry, of the Israelis allowing Ismail Haniyeh to continue to live in Qatar? I mean, we talked with Bobby Ghosh yesterday, who told us.
So this gentleman,
he's the leader of Hamas.
He's the leader of Hamas, and he's now,
and he lives in Qatar,
okay,
and he is alive.
Okay.
And so yesterday we were talking with Bobby Ghosh, who pointed out that the Arab states' armies are not serious, fighting groups. And I imagine if Mossad wanted to go in there and take out Haniyeh, it would be no problem. Why don't they do that?
Well, I do think that, there is a benefit, I think, of still having some kind of interlocutor. There are, for example, talks taking place now on trying to get hostages out, freed. There are more than 200 hostages, Israeli hostages being held in Gaza. And apart from that, there's so much criticism now of what Israel is doing in the Arab world that I just don't think that they would want to do such an inflammatory thing as that.
I also wonder, you're in a unique position as a reporter, Henry. You were based in Moscow before this, even got, I think, a master's degree at Moscow University. So you spent a lot of time covering Russia, covering Vladimir Putin, and the beginning of the war in Ukraine. How does this play into all of that? Because my first thought was, when I saw that Hamas had committed these attacks, is this draws so much attention away from what Vladimir Putin is doing in Ukraine.
Yeah, I mean, I think you're absolutely right. The Russians see this as an opportunity. They see it as something which is going to draw U.S. attention away from Ukraine. I mean, there was already a sense that the focus was switching. You saw that when aid to Ukraine got held up in Congress, And now, the sense is that, well, the U.S. is not going to be able to focus on two things at the same time, that the focus is going to be on making sure that, Israel gets the military assistance it needs, and therefore Ukraine is not going to get as much help as it was getting in the past. So very much so, yeah, from a Russian perspective, they see the tide turning in their favor.
Henry, what do you believe, or what does the average Israeli believe that they will get from President Biden tomorrow? Is this simply a show of solidarity, or is there anything particular that you think Israel really is going to ask of the president?
Well, I mean, I think the fact of his coming here is going to be seen, as making sure that Israel's enemies know that the U.S. stands with Israel, and that is particularly aimed at Iran, of course. The risk now that everyone is concerned about, and that the U.S. particularly has been trying to sort of counter that threat, is of this conflict spreading to the region, and specifically if Hezbollah, which is backed by Iran, launches major missile attacks from Lebanese territory into Israel, you could see this war becoming a much wider war in the region, with potentially also drawing Iran into it.
Is he going? He's going to meet with King Abdullah, I know, in Jordan, and possibly El-Sisi in Egypt as well. Do they stand with us? Can those two countries be counted on as U.S. allies? Or, I believe they talked to Putin first.
Those two countries, have been warning about the risk, the impact that would follow if Israel launches a large-scale offensive in Gaza. They're very concerned about that. And,
right.
Secretary Blinken crisscrossed the region just in the last few days to try and enlist Arab support for Israel's actions, but he was not successful.
All right, Henry, thank you so much for your reporting there. Henry Meyer, senior reporter, economy and government for Bloomberg News.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. Also,
you know what I do
live
when I
YouTube.
get cash?
Yeah.
When I have a fair amount sitting around on my bank balance,
you spend it.
Of course, but how do I spend it? So,
motorcycle?
There's things that I'm always looking for. A good place to buy clinch boots, engineering boots made with Shinki horsehide, the kind you can only get out of Japan from one tannery there that makes the best horsehide in the world. Or if I'm looking for jeans, I'll go with Samurai denim, and I like 25-ounce Samurai blue jeans, made the old-fashioned way on looms that Americans sold the Japanese a century ago.
All right, so let's just go.
Or I like the real McCoys. The best place to get flight jackets like A2s or B3s that are like perfect compared to the old ones, only much higher quality in terms of the leather and stitching. All of this stuff comes from Japan. So how do I get it?
Rakuten.
That's right.
Boom.
There's a website that I use to buy all of this stuff. I've grown up saying Rakuten, but maybe it's Rakuten.
Let's ask our next guest.
Yeah, let's do that.
Julie Van Ullen. She's the Chief Revenue Officer for Rakuten. Who pronounces it right, Julie?
Rakuten is the way to go.
All right. Well, I've been using it for years, and Paul has never heard of it. So talk to us about the other things that you can do on your website, because you're the Chief Revenue Officer there, which I guess means that you're in charge of making more and more money. And I only use it for maybe one niche part of your business. So what is Rakuten?
So, and my job isn't just making money. It's really about ensuring that all of the merchants, so the brands and retailers who use our site to have access to the loyal shoppers who go to Rakuten to start their purchases, have the best experience possible. So effectively, Rakuten offers cash back to shoppers and helps brand and retailers engender loyalty through the shopper base who uses Rakuten to shop for everyday purchases.
So give us an example, Julie, of kind of a typical retailer or that uses your site to reach your customer base.
Well, we range a vast array of categories from apparel to footwear. So you have your department stores, you have luxury department stores, so a Macy's, a Bloomingdale's. We have direct-to-consumer brands. We have over 3,500 brands on the site. We also are across the travel vertical as well. So really hard pressed for shoppers, for consumers to come to our site and not find what they're looking for.
So give us a sense of how the consumer is behaving today. We had some really strong retail sales numbers reported by today. And what are you finding on your platform? How's the consumer these days?
Yeah, I mean, your question is actually a great segue because we see such a vast array of purchases from across a number of categories, and we've been tracking the consumer sentiment and what they've been buying over the last couple of years, of course, which has been pivoting and changing constantly given the economic conditions. But what we're seeing right now is, of course, the CPI rose a little bit, which means that consumers are still feeling tighter budgets due to inflation, especially since that core inflation is what's impacting folks. Student loan debt repayments resuming. So that's still a burden. But what we're seeing now, especially given the retail trade sales have gone up a little bit, is that they're still willing to shop, and they're still willing to shop, using discretionary spending as well. So while year to date, there's been this trade down effect, whereas if you shopped at a high-end department store, perhaps you've been shopping at more of a discount department store year to date. That will continue because discounts, deals, value is definitely going to be central to the consumer mindset through the holidays. But it's interesting already to see a willingness to increase discretionary spending start to uptick, which is something that we would anticipate to see throughout the rest of Q4.
How are your customers paying for the stuff that they're buying? I mean, imagine they could do that with a credit card or the debit card. There are a million other ways nowadays with PayPal and Venmo and buy now, pay later. How are you seeing that breakdown?
So at Rakuten, we don't actually facilitate the purchase. We facilitate the consumer engaging with the brand of their choosing. So you would start your shopping trip at Rakuten, but say you're shopping at Macy's, you would shop at Macy's just as you would if you went to their site directly. And of course, most brands and retailers these days are offering an array of ways to shop and buy now, pay later.
But what is the unique selling point? Why wouldn't I just go to Macy's directly? Why do I make a stop at Rakuten?
Yeah, so Rakuten is a place where you get cash back on your purchases. So we have a hugely loyal base of shoppers who shop more frequently, who shop across different categories when they can find an offer that is enticing for them. And I think what's so interesting to a lot of brands, especially going into a season like this, where you have consumers who are looking for value, you have a lot of brands who aren't interested in the discount space, who aren't interested in offering coupons. There's brand devaluation associated with these things. But at Rakuten, this is really an incentive where consumers can come and get an exciting offer via cashback to shop more, buy higher value cart sizes with these brands, and shop more frequently through the holidays and feel really good about what they're doing because they're getting cash back.
Well, what are some of the retail partners that you work with? What are they saying about this holiday season coming up here? Because again, the retail sales today look pretty darn strong.
Yeah, they are strong, and they're going to continue to be strong. But I think the thing that everyone is aware of is that consumers are going to be looking for the best bang for their buck this holiday. And for retailers this year, especially coming out of the last couple of years where the focus was on top line spend. It was just ensuring sales, ensuring that the customer base that was loyal to these brands continued to shop with them through hard times. Gross margin kind of went out the window for the last couple of years. But this year to date, it's been a bit of a back to health focus for most retailers and brands. But what I will say that we're hearing from nearly all categories and all brands and retailers is that they realize that this is going to be a very, very competitive shopping season where discounts and value adds are going to be central to what consumers are looking for to make their dollars go as far as possible. So brands are really focused on how to make sure to get the best deals in front of the best shoppers and meet them where they are this holiday.
So what categories are really moving these days? I mean, when I go into the holidays, I always kind of hear electronics, things like that. But what are consumers really looking for these days?
Of course. I mean, nothing's going to change in terms of what are giftable categories that consumers will be shopping this holiday. Certainly electronics, certainly apparel, and certainly luxury. And I think that that's actually one of the more interesting categories right now, because luxury tends to be one of those categories that doesn't really see a lot of impact from changes in the economy. And we kind of affectionately say that that's because the rich stay rich. But we're actually seeing some changes in the core shoppers who shop luxury typically, which is a good lesson to learn for really any brand heading into Q4, which is to say that with current economic challenges and consumers making different sorts of decisions as to where they spend their dollars, they need to figure out who is buying their products these days. What are the Gen Zers spending on, and how can they attract and engender loyalty to new shopper bases and categories who might not have been the traditional focus of their marketing spend.
All right, Julie, thank you so much for joining us. Really interesting conversation. Julie Van Ullen, she is the Chief Revenue Officer for Rakuten.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Tucker and I are proud natives of New Jersey, so that means we know malls.
Yeah.
We know shopping malls. You know, when I lived in Summit, New Jersey, right across the street was the Short Hills Mall.
Which is a nice mall. That's the mall where you can get valet parking.
Yes.
It's a
Dude,
classy.
I can get valet parking at the Westchester. I could get valet parking at the City Center in Columbus.
Are you a mall guy?
I'm a lover of malls, yes.
Okay, I'm
both indoor and outdoor. But I reject the notion that you know more about malls being from New Jersey than I do being from Ohio.
Not even close.
You don't.
Oh, yeah.
You live near malls, but you don't go to them.
No, God forbid.
Have you been to the American Dream Mall?
No,
All right, you live near the most impressive mall probably in the whole country, and you've not been there.
That's a good point. Our next guest knows about this mall thing. Donna Blair, she's a COO of Pacific Retail Capital Partners, and these folks there, they invest in malls and all kinds of retail stuff. She joins us here. Hey, Donna, again, I'm a huge fan of the mall, kid of the 80s, all that kind of stuff. Where are we with the American shopping mall today? A lot of folks were saying, particularly with the pandemic, that business is dead. Where are we with that?
No, good morning, Paul. Good morning, Matt. Thank you for having me. I think that at Pacific Retail, we have a different opinion about malls. We look at the malls not just as is, where is, but really where are they going? And the future of the mall is not necessarily all retail. It really is this mall to mixed use approach where you look at the real estate, you look at the demographics, but more importantly, you look at the psychographics. Why is the mall important? Is it from a retail perspective, or really is it more about creating community and lifestyle? Mm-hmm. And our focus at PRCP is really being strategic in that approach and trying to really reposition the mall into more of a mixed use asset that is going to have to evolve from just retail to being more that lifestyle and community.
So do you guys focus on the enclosed mall or the open air mall? Because Matt and I have had some retail investors come in and say, hey, the open air mall, there's a lot we can do with that kind of business. How do you guys view the market?
Sure. We focus on both. I would say a majority of our centers are enclosed shopping centers. But when you look at the plethora of real estate that an enclosed mall has in terms of the parking fields, the anchor boxes, it actually has a lot of real estate that can be repositioned. And so that ability to kind of pivot and change and evolve the asset is super important in terms of making sure that it's relevant. There will always be retail as part of a mall, but how do you actually reposition it? And they're a little bit more complicated when you look at the enclosed malls, because you've got reciprocal easement agreements between the owners of the mall and then the anchor tenants, some of your major tenants, and also the municipalities. So they're going to govern everything. What are the uses? What are the parking availabilities, the parking counts, how tall, how wide? And it really is, how do you strategically unlock all of those encumbrances to create value in the real estate and reposition it. And that's how we're really focused on the mall-centric assets that we own, is just to do that, to unlock their actual value of potential for us as investors and owners, but more importantly for the community and the consumers too.
What are the main complaints, or what do you aim to change compared to a typical mall? Because as I said, I'm a huge fan. I love these indoor shopping centers and outdoor, communities as well. But there are issues, like they all seem to have the exact same retailers, which I guess those would be your anchors, right? I went to a mall in Berlin and noticed that they had the same retailers as the mall in Westchester. I don't need to have a Gucci, a Coach, and a Neiman Marcus in every mall I go to, So how do you make those kind of changes?
No, for sure. I think what we're focusing a lot is on that dynamic mix. There are less national tenants that are actually in the business these days. And so right-sizing the amount of retail and then creating that diversification is important. Local is key. We spend a lot of time in our leasing strategy really focusing in on local businesses, whether they're mom and pop restaurants or whether they're local retailers, and we put them together in collectives so that you can really get that local flavor. We find the community's more interested in that because, to your point, it's something new, it's something different. You're not seeing it everywhere. But more importantly is that the community is committed to helping their own, to actually help bring those businesses to life and to support them. So that's a really important focus. You're seeing obviously a lot more food and beverage and entertainment because the experiential aspect of the shopping center is really super important. And is the way that we are going to be able to create that experience where our consumers come back over and over and find something different. It's all about that activation, the experience, and then that diversification of your mix.
Donna, with the cost of capital rising dramatically over the past 12 to 18 months, what are you guys doing in terms of your acquisition activity? Has that kind of made the economics a lot more difficult?
Certainly. The investor pool is a lot different, and we're not going to traditional institutional investors. We're really seeing a lot of individuals from the high net worth category, family businesses enter the market. We have actually found a little sweet spot in distressed. You were talking about New Jersey when you opened up, and we just recently acquired in May Bridgewater Commons. This is an asset that has really strong demographics, really strong psychographics, but really was in a distressed state.
So we were distressed mall in New Jersey. How about the Livingston Mall?
The Livingston Mall. Those are tougher assets to really reposition. Focusing on an asset like a Bridgewater Commons, we're really able to capitalize on the strong demographics there and be able to reposition it. So we look at a strategy that is more mall to mixed use and looking how do we bring densification. So that's residential, that can be for sale product, for rent product, it could be market rate, it could be senior living. And how do we really blend all of those different types of density strategies to drive traffic, but more importantly, to drive lifestyle back to the mall?
Hey, Donna, we had some really good retail sales numbers out today. What are your clients, what are they saying about this important holiday season coming up?
Sure. I think that we were all a little bit surprised by the sales this morning, especially when you look at the core sector, 3 times what the projections were. I think we have to caution ourselves that cost of goods are higher. And so when we look at the 0.7% increase, that there is still some consumer resilience, which I think is super important looking into holiday, but there also is, there's a lot of caution, headwinds that are happening here. Credit card debt is climbing. Yep. We have a lot of defaults. We're seeing the highest in 11 years. We're also seeing that student loans are now having to be paid. Yep. And so that's going to put pressure on holiday sales. I think that when it comes to gift giving, people are still going to be spending the money, but they're going to be looking for the values, and they're also going to change their trends. Right. They're not just going to be from Black Friday, until the day after sales. They're starting earlier, and certainly with Amazon last week, we saw that in growth.
All right, Donna, thank you very much for joining us. Really appreciate getting some of your thoughts there on the greater retail business, the shopping mall business.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
In the deal front today, Wyndham Hotels and Resorts rejected a takeover offer from Choice Hotels, saying the proposal undervalues the company's potential for growth and would be subject to a lengthy regulatory review. Let's break down this deal or non-deal with Jody Laurie. She is the credit analyst with Bloomberg Intelligence, who follows the hotel industry, all the leisure industries from a credit perspective. Jody, thanks so much for joining us via Zoom here. What's going on between Choice and Wyndham? Are we going to get a deal done here? What's going on?
Yeah, so I mean, Wyndham kind of came back to Choice and said, hey, listen, we are, the words that they used were, it was underwhelming, highly conditional, and subject to significant business, regulatory, and execution risk. And the way that I read that and my initial take on the deal was, if they were going to go with the financing that they proposed, which was half cash, you're talking about $4 billion that likely would come from the debt markets. We put that into perspective about where the debt markets are now and where interest rates are. I don't know if you necessarily would like the cost of financing this sort of transaction, considering where cash flows could potentially be for the two companies.
What do you think the cost of financing would be? Are we talking like Carnival Cruise pandemic level costs?
No, I don't think they would be that high. We're looking at two companies. So Choice is BBB- by Moody's and S&P, or Baa3 by Moody's and BBB- by S&P. And then you have Wyndham, which is one notch lower. So it's the highest notch in high yield, which is Ba1 BB+. And so those two companies together would probably command somewhere closer to what we've been seeing across standard sort of high yield rates.
What's the
now
number?
The question is,
we don't watch junk debt all day. What's the number? How much?
Well, it depends when the transaction gets done, because interest rates have been changing all the time. I mean, I think the key is
9%.
For this, the question is
double digits.
No, I think it's a little bit less than 9% at this point. I mean, I think if we're talking about, okay, so we're saying it's a $4 billion company. I think the big question is, for a company like this, you say, okay, $4 billion company, or $4 billion of debt, rather, for a company that combined would be about $3 billion in revenue. It's sort of like a weird scenario, because you're like, okay, would investors really feel comfortable with that? Would they not? Are we looking at like a 7 or 8% rate like we saw last week with Norwegian? Are we looking, is it going to be a little bit better than that because they're a little bit higher rated? I think it would depend, where they decided to go in the yield curve, although right. The yield curve right now is so flat that it doesn't matter.
So Jody, what's going on in the hotel space here? Why does Choice think that this is the deal to do here?
So I think what's happening with Choice right now is they're in a spot where they've improved their balance sheet. They are starting to generate cash. They're seeing that the larger hotel companies, such as the Marriotts and the Hiltons, are very interested in their space. They have sort of a commanding presence in the extended stay and budget area. That's where Wyndham operates primarily. That's where Choice operates primarily. Well, now Marriott and Hilton are saying we want a piece of the pie. And so they've been aggressively expanding into that area. And I think Choice is trying to stay ahead of that conversation by looking at Wyndham and saying, hey, here's two very large companies. Let's also be a very large company to compete with them.
So the budget hotel space, how is that different from, where Matt stays, the Ritz and the Four Seasons every time?
Well, if he wants to check in one of the Super 8s, let me know.
Okay. Is that a good business?
I do want to. I got to say, I was just about, before the flood a couple weeks ago, to drive to Ohio, and my dream was to bring my daughter along, and we would stay at a Motel 8.
Really?
Because that's what you do on
Motel
a road
6.
trip, right? It's such a cool thing. Little kids, I remember when my dad took me to stay at a Hojo's or a Motel 8 or whatever, and it was like awesome then. It didn't happen because of the flood, but these brands would be, they would have Days Inn, they would have Ramada, they would have Super 8, right? That's not to be confused with Motel 6. So they have like a lot of really cool brands that are still named after big automobile engines of back in the day. Are those like popular? Are they profitable?
Yeah, I mean, they're certainly profitable. You see cash flows generated. So the two companies each, I mean, they generate, you're talking somewhere in the 300s range for Choice, what's to be expected for 2023 or 2024. And then for Wyndham, you're expecting 400. At least that's what our MODL screen shows for consensus estimates. That said, I mean, I think it's a different sort of, when you talk about the structure of the company, it's a different sort of concept to stay at an extended stay than it is to stay at the, high-end resorts. You're looking for a different feature. A lot of people who stay at extended stays are staying there for different reasons. And also the definition of extended stay can be different among companies. So some companies like Wyndham will say extended stay, we really mean extended stay. You're doing a renovation on your house and you have to stay somewhere else for a little bit of time. Other companies say extended stay is more on the, competitor to Airbnb type.
So how has Airbnb kind of impacted your industry, the hotel motel business, just in general?
I think, what's most interesting is that the companies have had to reconsider how they do their business model. There's going to be consumers who always stay at hotels for whatever reason, whether they're dedicated to insert your favorite reward system. But then there's going to be people who are looking for the cheapest alternative and the most convenient alternative, which during the pandemic, we saw much more of that. We want a kitchen, we want this, we want that, that's going to come with this stay. We just don't want a small hotel room, particularly if we're trying to stay away from other people. That might shift a little bit more now that we're getting back into the quote unquote normal times. You're seeing a little bit more pickup in business and conference travel. We were actually just in Vegas last week, and the conference situation there is much more on the quote unquote normal side than
Where'd you stay in Vegas?
A year and a half ago. I'm sorry, what'd you say?
Where'd you stay in Vegas?
Oh, I stayed at the Venetian because that's where the conference was.
Paul's
it was the big.
I'm a Bellagio guy. Next time you can go there, use my name.
Yeah.
They'll take care of you.
So the
Bellagio is beautiful.
Yeah.
Just while we're playing with hypotheticals here in terms of the debt, would this kind of deal sell debt in the market, or would they go to a private credit place and get a loan there? Because now we're starting to see deals. I think we saw a $5 billion private credit deal, and the idea is that these numbers are going to keep growing. So they could handle this. What do you think?
I think we're a little bit in early stages to figure out how they go financing. Choice did indicate that they
just thought it would be fun, Jody. Would it be an option?
I mean, Choice. Yeah, no, I mean, it's definitely, anything's a possibility. Let me put it that way. Anything's a possibility. That said, Choice indicated that they are working with two banking companies that, two bankers that said that they could give them financing, give them short-term financing while they go and secure longer term. That said, yeah, I mean, the public markets, it's really a question of timing. So companies come to market and it's terrible timing and they get these horrible rates like we saw with some of the other companies I cover. Then they'll come to market, they'll get these fantastic rates. So it really is just a matter of timing, and it's a matter of how comfortable people are with the deal. Now, in normal times, the lodging industry is usually pretty sleepy. People aren't super excited by it unless there's some sort of transaction that happens. Then it becomes a little bit more interesting. Normally, the bonds don't trade all that much for lodging. So this is the type of thing they say, oh, we can wake up from our beds of lodging and decide to really care about that was my terrible way of making some sort of analogy. It was E for effort. But companies can, now we're starting to see that their bonds are a little bit more volatile today. So it is exciting. It's unlikely that, for the Wyndham bonds, it's a negative per se. Although, it's really a question of whether or not the change of control gets triggered. I don't think it would, in which case, the bondholders are kind of taken for a ride. So it'll be an interesting thing to play out. Right, I don't really know how much more it's going to go, though.
Yep. All right, we'll stay on top of this deal. When we get anything else, we'll get back to you. Jody Lurie, she's a credit analyst for Bloomberg Intelligence following the lodging industry. And again, a potential deal here in the lodging business. Choice Hotels taking a look at Wyndham Hotels, and they're jockeying back and forth on price. We appreciate getting Jody's points.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.